this is basically how it looks like. Before the exit, he was getting about $100,000 a year in salary. After the exit, he jumped to $300,000 per year in salary as part of the agreement with his acquirer. Before the exit, they didn't have any performance bonus. It's a classic pre-exit founder profile. Like, didn't make much money, mostly grinded his life and tried to build a business. And the happy event happened, and he was actually selling it and got like some good liquidation. After the liquidation happened, the founder had like the $300,000 a year in W2. The installment sale, they split it into two payments. One is $3 million in year one, and then in year two is $2 million. When I say year, by the way, I mean tax year. It means that they can get paid at October in one tax year, and then in February the next year. And from an IRS perspective, those are two different years. So that's year one, year two. So that's another thing important to keep in mind. And beside that, they had also a lump sum upfront payment of $3 million. And that is one time that they received. After the acquisition, they also had like some consulting income that went up and down throughout the years, depending on how much time they wanted to invest and advise other companies. So the total taxes based on year one on our calculation was $791,000. On year two, almost like $1 million. And year three, they just took a sabbatical, basically, and the taxes were very, very low. That's the context. That's what happened there.
Yeah, and so I'm going to focus for the next 2 minutes or so on that lump sum payout, because that's one part where Valur really comes in and is maybe one of the only firms out there that's going to help with that lump sum, and specifically some pre-event planning. And so in this case, what this person could do, given that he was going to receive a lump sum payout of $3 million, is he could use one of the various vehicles to shield that lump sum from capital gains tax. And what I'm going to talk about here is what would have happened if he had pursued a charitable remainder trust versus not. So a $3 million payout, given this person's situation living in New York, is typically going to yield somewhere in the range of about $800,000 in taxes. In fact, maybe a little bit more. And so he might keep something like 2.2 million out of that 3 if he does no planning. That 2.2 million over many years might grow after taxes to about $6 million, 5.75 here on the chart. Instead, what you can do, and what many of our clients do, is to set up a charitable remainder trust. A CRUT, C-R-U-T, Charitable Remainder Unit Trust, is a vehicle. It's an account. It's a trust that is tax exempt. And a lot like an IRA or a 401k, what you can do is you can put assets in there and buy and sell and do whatever you want with them, and they won't be taxed at that moment. And this is what I talked about earlier on with the idea of tax deferral. The idea with a CRUT is you put the asset in, it grows over time. You sell the business, then the reinvested assets grow over time, but you're not paying taxes until you pull the money out. And so given some assumptions, 8% annual growth, not crazy, kind of historically average returns for reinvested assets, not touching the money for a few years to let it compound, and then running a trust for this person's entire life, what you see is the combination of tax deferral and strategic taking of distributions yields significantly more money after taxes over the long run. In this case, an extra $8-9 million. And this is representative, but it is very representative of the standard case, where if you can, instead of paying $800,000 in taxes on your $3 million lump sum in the first year, instead you pay $0. Well, the difference between those two numbers reinvested for many years gets very, very large. And that's the power of compounding and of tax deferral. I won't belabor it too much. Many of you have heard us talk about CRUTs before. But just to say that when you are planning for an event like this, or just the simple sale of some Apple stock or cryptocurrency, really any appreciated asset, a little bit of advanced planning, setting up a trust like this in the months before that event can yield, as you can see here, 2 or 3 times the lifetime returns. call, then once they've done that, there's still a bunch of money left, as you laid out: income, installment, sale, and consulting. And that's where your kind of post-sale planning comes in.